Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip discusses the collateral damage left in the wake of the Fannie and Freddie Conservatorship. It seems like whenever regulators and Congress agree on a new recipe for alphabet soup, they create problems that were not anticipated. Some of this collateral damage is difficult to explain. I have read a report that the bailout triggers settlement of $1.4 trillion in unregulated credit default swaps. I don't understand what this means, but it appears that some hedge funds could be on the hook. There are $62 trillion of these swaps outstanding, and back in 2003, Warren Buffett described them as financial weapons of mass destruction. According to Market Intraday, Washington Mutual's credit default swaps jumped to 31.5% on an upfront basis. In other words, it cost $3.15 million to insure $10 million in debt for 5 years, plus annual payments of $500,000. WAMU is rated a strong sell and closed Tuesday at $3.30. Also a problem is that many community and regional banks own Fannie and Freddie stock and convertible preferreds. With these assumed to be worthless, smaller banks now may be below capital guidelines. The FDIC is seeking calls from banks below the well-capitalized category if they have exposure to Fannie and Freddie equity holdings. A bailout of investors in GSE debt and mortgage-backed securities could cause a wave of bank failures on Main Street. Again, regulators help Wall Street and investors at the expense of Main Street and taxpayers. My second blip explains the difficulties the FDIC faces as the great credit crunch intensifies. The FDIC fund currently has a balance of $45 billion. This fund has been 100% industry-backed. The FDIC has a line of credit with the U.S. Treasury of $30 billion, which has never been used. The FDIC also has a separate undisclosed line of credit with the U.S. Treasury to cover short-term liquidity needs, which will likely be used as the level of bank failures increases. When bank failures rise, the FDIC has fewer liquid assets and more illiquid assets. This credit facility through the Federal Financing Bank gives the FDIC working capital until the FDIC sells the assets attained. The Treasury's Federal Finance Bank was created by Congress in 1973 to centralize and reduce the cost of federal borrowing as well as federal-assisted borrowing from the public. My third blip looks at U.S. Treasury yields and Fannie Mae spreads. The yield on the 5-year U.S. Treasury continues to trade between 2.75 and 3.27 since last Friday. The 5-year Fannie Mae spread, which declined from 94.5 basis points on Friday to 63 basis points on Monday, moved back out to 70.6 basis points on Tuesday. Risk aversion has not gone away. According to Mortgage News Daily, the 30-year fixed-rate mortgage, as posted by Freddie Mac, remains at 6.35%. Compare this to Bankrate.com, which posts a 5.88 30-year fixed rate. Try to figure that one out. My fourth blip looks at the weekly chart for the Dow Industrial Average. The Dow has been essentially below its 200-week simple moving average at 11,747 since the end of June. Monthly and annual supports are 10,836 and 10,747. A monthly close below the 120-month simple moving average at 10,628 signals a multi-year bear market. If you have any questions or comments or want to order a copy of my special report covering the great credit crunch, shoot me an email. My email address is gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.